So basically, earnings have come in okay. They've beat kind of subdued expectations. The growth rate is moderate relative to history. What's your key takeaways so far, and especially as we go into this very busy week?
I mean, so far, to me, one of the biggest takeaways from a macro perspective is that the U.S. consumer, at least to date, is holding in pretty well. And I think that came across most strongly with the bank earnings. So to me, that was important because we know the consumer is about 69% of the economy. So if they're doing okay, the world's doing okay. And I think Alphabet's numbers obviously were pretty important for that thematic AI trade and suggest that this week's tech companies will probably be okay. But really what I'm watching more than anything else is the qualitative assessment by the executives on where we go from here. I don't really care about the backward looking. I want to know, are input costs going up yet? Are they investing more or less, et cetera? Because their sentiment will drive corporate activity over the next 6 months. And that's going to be a big factor for the broader macro view.
Speaking of sentiment, this all comes against this backdrop where valuations appear pretty stretched relative to history. You've got meme stocks back, crypto back, SPACs are back even. What does that tell you just about the overall kind of fervor in the markets right now?
I mean, valuations are much more useful on a 5 or 10-year horizon. I would never use a PE multiple to tell me what to do for the next 3 or 6 months. But I think that broader picture that you just described is one where there's a lot of bullishness, I think, especially by the retail investor community. And so we need to keep a close eye on that. You all talked in the last segment a little bit about the trade. I think with U.S. and China, it's so interesting. We need their rare earth minerals, period, full stop, probably for another decade before we're self-sufficient, at least. They need our chips. And we need our chip companies and our AI companies to be thriving because that creates the wealth that underpins the economy. So I feel like both sides, U.S. and China, have gotten this message over the last few months that they're going to have to do some compromising on both sides to get their way for their longer-term goals. President Trump wants a strong stock market and a strong country. That means the chip sector, the tech sector has to keep doing well. And we're getting pushback on that. Not everyone thinks it's a great idea for the U.S. to be sending China chips.
You wrote this editorial in the New York Times a couple of weeks back, I think it was, Rebecca, in terms of Fed independence.
Yeah.
I got a little pushback from some people who follow you closely, respect your work a lot, but said comparing us to Hungary or Turkey doesn't seem fair. I mean, we are the reserve currency. Give me your thoughts on that, because you did make that comparison and pointed to some potentially very bad outcomes for the dollar, not to mention sort of overall longer term rates.
I mean, I think it was in my third paragraph where I said pretty succinctly, the U.S. is not Hungary or Turkey. We are the reserve currency. But what I wanted to make the point that whether you look at the U.S. in the 1970s, whether you look at Hungary, Turkey, Argentina, Venezuela, any country around the world that's had a reduction of Fed or central bank independence, the directional outcome is the same. Weaker currency, higher inflation, higher long-term yields. So, no, I don't think we're going to have 35% inflation in the U.S. I hope to God not. It would be, I don't know what would get us there. But I do think that even the perception that the Fed is losing independence can affect inflation expectations, inflation pricing that you all were just talking about a few minutes ago on the show. I think we're already starting to see that. And gosh, whoever replaces Powell, that person is going to have to prove themselves. There's going to be an assumption that they're going to have some political bias. And that's really a shame, right? It's putting a greater burden on that person to make the right decisions for the country.
We're looking for maybe 2 dissenters this week. Isn't an equally large story about what may be a future of dissent and what that does to rate volatility?
I mean, to have 2 governors dissent is something we haven't seen in a very, very, very long time. But to have dissents in general is not that unusual. Again, it's unfortunate. The fact that this has been politicized so much, the fact that they were both Trump appointees, people are making an assumption that this is a political dissent when it very well may be, and I think it probably is, their true view on the economy. I don't agree with Waller that the economy needs a rate cut right now. I mean, the stock market at an all-time high suggests that rates are not overly restrictive. And the fact that the housing market is troubled because of mortgage rates being high, that has a lot more to do with the 10-year than the Fed funds rate. So I disagree with him, but I don't think it's a political view. I think that's just how he's seeing the world.
Do you agree that in his view, or I guess more like Warsh's view, that the Fed is not getting the productivity surge we're about to receive courtesy of AI?
But When do we receive it? How big is it quarter to quarter? I mean, the Fed is trying to figure out the right Fed funds rate today for the economy over the next 18 to 24 months. They might have the best PhDs in the world, but how do you model that? I don't even think the tech companies know exactly how much productivity gain we're going to get. So I think for Warsh, and I respect him tremendously, he's a brilliant man, but to say they should be setting policy based on something that no one knows, that's nonsensical to me.
It would also hard to figure out the inflationary impact of tariffs. So we're assuming now maybe it's 15% across the board. We were just having the conversation, though. It doesn't appear at this point it's a significant tax on the consumer. Where do you stand?
Right. I mean, we did see it in the last CPI report in some of the core goods, and Rashir mentioned that. I think going forward, the inventories that had helped us have been wound down. Transshipments helped, and that's something the government is going to get tougher on. So I do think there's a greater chance that we're going to see more of the tariff impact come through on prices. And then it's a question, how much does the consumer bear? How much do corporates absorb? And we don't know what that exact mix will be, but directionally, I think the risk is that we have higher inflation in the second half of this year, and that means that 2 Fed cuts by January is at risk.